Welcome to this series of sessions, getting the most out of VantagePoint indicators, the predicted next day highs and predicted next day lows. Other VantagePoint indicators predict trend direction and reversals, but the predicted highs and lows can help you define specific points at which you would want to act. This is one indicator that answers that important question for traders: what might happen tomorrow? Trading when you have an idea about the next day's trading range, the price range will help you to determine whether you want to trade a breakout or whether you want to trade within the range in an intraday fashion. And then finally, it helps you to set up some channel breakout criteria that can help match the amount of risk you're willing to take on any trade. The predicted high, the red line, and the predicted low, the black line, define the channel within which you can trade in several different ways. The possibility exists you can trade breakouts of this channel, or you can trade within this channel. It depends on the context of the current price action as to what you might do. If you see a channel that is moving up, as it is in this fashion here, in a nice trend, when you see a break of that trend, that provides a signal, a key point at which you might want to make a decision. We are going to take a look now at the daily report to show you how those numbers look on the daily report. The daily report shows several columns that help us determine predicted highs and lows. You can see the predicted next day high, the predicted next day low. Some people can look at a chart and that's all they need because they're more visually oriented. Other people will be more numbers oriented. What you see here with the predicted highs and the lows on the chart are the precise numbers. These are numbers around which you might want to place a stop to either enter or exit a market. Now we want to go back to the chart and to show you a little bit more about the process of trading the breakouts. If you see a trend that is moving to the upside like this, you will want to trade the breakout to the downside. If you see a trend that is coming down like this, you will want to trade the breakout to the upside. The point at which you will place a stop to get on board those trends will depend upon how much of a risk tolerance you have, how much leeway you want to give that move before you get into a market where you have a situation like you see on these two bars here where the market jabs down below the low but then does not go on down. You would like to place your stop far enough below the predicted low so that when you get into the trend, it is truly a trend. In this case, on this chart, we are looking at the E-mini, a popular contract for many traders. This point here could be 5 points, it could be 10 points, it could be whatever you determine. You want that stop to be below the predicted next day low. That will depend upon the amount of risk you want to undertake, will be determined by how the other indicators are indicating what the trend could be. A number of things are factored into that, but you will have to determine where to place that stop. Then, once you are in this position that is moving to the downside like it is here, you want to have protection against a move in the opposite direction so that you don't incur a big loss. In that case, you would put your stop above the predicted next day high. If this high is too far away from the predicted high is too far away from the predicted low and your parameters are too wide, you will have to consider the fact that the risk may be too much for you to take that trade, and you will have to use other indicators or other techniques to determine where to place that stop so that you don't get into those big risk situations. Another type of strategy that can be used with the predicted highs and lows is to trade intraday, and that is to trade when the market approaches the predicted next day low or when the market trades near the predicted next day high. Depending upon which is hit first, you could be long, you could be short. But this is an intraday trade. It requires somewhat closer monitoring of the market and what is happening in the market, because you don't want to get caught in a situation where you're exposed to high risk on a short-term trade. When you establish your risk parameters, because of the nature of the markets and the amount of risk that they could involve, you may want to do only the smaller contracts. In the case of grains, you have mini contracts. In the case of Forex, you have micro Forex contracts. So it could affect the type of contract that you do trade. But the predicted highs and lows are a key point in determining specific areas where you might want to enter or exit a position. Now let's review some of the key points that we can implement using the predicted highs and lows. First, what we need to know about the highs and lows is that forecast provides you with the next day's predicted trading range. Knowing the range helps you determine how you might want to trade. Secondly, you must keep the context of the current market action in mind, because that will determine some of the breakouts and other ways that you might want to use the predicted highs and lows. Third, with the breakout criteria, you have the possibility of setting entry and exit points at a variety of points depending upon your tolerance for risk. The predicted trading range, it can also be used for intraday trading by fading the predicted highs and predicted lows, but it is a market that you must monitor more carefully. Other indicators should dictate to you how you use this predicted range, whether you want to trade intraday within the channel or the breakout of the channel. And finally, guidelines for risk are very important to consider in whatever strategy you use. Thank you for watching this session. Please visit the Market Technologies Learning Center for additional tutorials.